Imagine thinking a dispute is finally over, then realizing the fight is just changing arenas. It started with about $33,000 in tax year 2022 items tied to a deficiency notice, then got narrowed to around $29,000 once the taxpayer considered roughly $4,000 of wages. About 13 months after the notice went out, the dollars at stake shifted by about $4,000 and the court ultimately allowed about zero of the settlement to be excluded, meaning roughly $29,000 stayed in income. A settlement check turned into a plain language warning. Calling something injury related is not the same as proving it's tax free. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. And if you like these real-world tax court stories, please like this video and subscribe to this channel, because this channel reviews and analyzes U.S. tax court cases to understand how U.S. tax law works. In this video, we cover the tax court decision in the case of Tony Perry versus Commissioner of Internal Revenue, decided on February 18, 2026. This one arrives as an oral finding of fact and opinion, bench opinion, given from the bench by the judge, with the reminder that it shall not be relied upon as precedent. That warning matters for lawyers building citation chains, but for the rest of us, it's still a clean little story about how a settlement agreement can control the tax results, even when the human being on the receiving end insists she didn't really understand what she was signing. Here's the cast as the court lays it out. The taxpayer lived in Connecticut when she filed her petition. She worked for a former employer identified in an opinion as Amazon.com Services LLC, starting sometimes in 2017. Over time, she ended up in a picker role described as involving substantial physical activity. And then, sometime during 2020, she injured her back and went to an emergency room for treatment. From there, the workplace story turns into a legal story. Based on advice she received, she sought to exercise rights under the Family Medical Leave Act of 1993, spelled out in the opinion as FMLA. She got approval from the employer for a FMLA-related leave of absence, and after that approval, she was terminated. The opinion doesn't add extra drama or commentary beyond those bits, but you can feel the stakes. A physically demanding job, an injury, a leave request, approval, and then termination. She sued. The court describes her lawsuit as raising claims that she was terminated in violation of state workers' compensation law, disability discrimination law, and the FMLA. And then, in tax year 2022, she settled the dispute. The settlement is the entire tax problem in this case, because the IRS treated the settlement money as taxable and the taxpayer wanted it excluded from income. Now we shift from workplace conflict to tax conflict. The IRS issued a notice of deficiency dated January 21st, 2025. The notice determined a deficiency for 2022 and also asserted an accuracy-related penalty. But by the time the case reached trial, the penalty was gone. Respondent has considered the accuracy-related penalty. Also, the taxpayer considered about $4,000 of the deficiency tied to wages. So the courtroom narrowed to one clean question: whether approximately $29,000 the taxpayer received under the settlement agreement was taxable income. Trial happened in Hartford, Connecticut on February 17, 2026. The next day, February 18, 2026, the judge delivered the bench opinion that we're reviewing today. No long written opinion here, no sprawling procedural maze, just the court telling a story with a legal spin to it. The taxpayer testified, and the court spends real time on what she said about the settlement agreement. According to the opinion, she testified that she didn't understand the nature of the settlement and that her attorney failed to explain it to her. She also testified she couldn't recall whether she received the entire settlement and thought the amount was different. That's the human piece. The person receiving a lump sum admitting confusion and essentially saying, I signed something but I didn't really get it. But the document itself pushes back. The court points to the signature page which she acknowledged she recognized her own signature, and that signature page includes language that employee acknowledges she had read the terms and understand the terms and effects. In other words, the settlement agreement didn't just transfer money. It tried to lock in a version of reality where the signer affirms understanding. With this setup, the tax law issue becomes a familiar one. Gross income is broad, exclusions are narrow, and the taxpayer has the burden to prove the IRS wrong. The court states that the IRS determinations are presumed correct, and the taxpayer bears the burden under Rule 142A, citing Welsh versus Helvering, and it repeats the standard framing that gross income includes all income from whatever source derived. So how does the taxpayer try to escape taxation on a settlement payment? The opinion goes straight to Section 104A, the rule allowing exclusion for damages other than punitive damages received on account of personal injury or physical sickness. The court emphasizes the two-part concept. The underlying cause of action has to be tort or tort type, and the proceeds have to be received on account of that injury or sickness. And because this is a settlement, the controlling question is the nature of the claim that was the actual basis for settlement. This is where the narrative hinges. People often think I was hurt means the settlement is for injury, but the court lens is, what did you actually sue for? What damages did you actually claim? And what does the settlement agreement actually say it's paying for? The court looks at the complaint filed on her behalf and says it raised 4 claims. But the key detail is that each claim asserted the same damages: lost wages and benefits, deprivation of future employment benefits, substantial emotional distress, and attorney's fees and costs. The court then draws a bright line. Damages other than emotional distress are clearly outside the scope of Section 104A, and the complaint didn't allege medical treatment for emotional distress as damages. The court treats that as fatal to exclusion. It describes the alleged damages as wholly outside the scope of Section 104. In plain English, the court is saying this lawsuit reads like a wrongful termination case seeking wage-type damages and emotional distress without tying the emotional distress to medical care amounts in a way Section 104 would recognize. So even if the back injury is part of the life story, the damages being pursued don't match the kind of personal physical injury damages that get excluded. Then the court turns to the settlement agreement itself. It describes the settlement as a lump sum received for a general release of all claims related to employment, except for claims related to a specific Connecticut Workers' Compensation Commission claim number. That exception is interesting because it shows the agreement carving something out, but the opinion scope points is that the lump sum being fought about in tax court wasn't paid as workers' compensation proceedings under that carved out claim. The taxpayer tried to support the exclusion by presenting evidence and testimony of physical injuries, but the court wasn't moved, partly because some injuries were unrelated to the settlement and many predated the alleged back injury date she claimed underlay the settlement. Most importantly, the court says she did not testify or provide evidence showing that any portion of the settlement proceeds were used or designated for medical care attributable to those injuries. That used or designated idea matters in how the court tells the story. It's not enough to have injuries in your life. The court is looking for a demonstrable connection between the settlement dollars and damages paid on account of personal physical injury or sickness. Or in the narrow emotional distress, carve out medical care amounts attributable to emotional distress. The opinion basically says we don't have that evidence here. And then comes the line that feels like the judge gently but firmly closing the door on the taxpayer's personal interpretation of events. The court says her testimony shows confusion or misunderstanding of the prior litigation, but it is not her understanding which controls here. Instead, the terms of the settlement are clear. And the court concludes there was not enough nexus to the underlying physical injury to transform this from a wrongful termination case into a Section 104A case. Nexus is a lawyer language, so let's translate it to a normal person. The court did not see a strong enough link between the injury and the payment. The payment looks like it was made to settle a termination dispute, not to compensate for physical injury damages. The court even narrows it further. At most, the settlement included some attendant unrelated emotional distress. And with that framing, it rules that the lump sum payment of about $29,000 was not excludable under Section 104A and therefore stayed in gross income. There is also a small side argument that reads like a last attempt to reroute the story. The taxpayer's counsel argued she could have sued for workers' compensation. The court responds that it takes no position on the proper tax treatment of this alternative, but says it's clear the lawsuit that was actually settled did not give rise to proceeds eligible for the Section 104A exclusion, meaning you don't get tax treatment for the case you could have filed. You get tax treatment for the case you did file and the settlement you did sign. So what's the takeaway from the story? A worker gets injured, seeks protected leave, gets terminated, sues, and later receives a settlement check in 2022. Then the IRS says that check is taxable. The taxpayer comes to tax court saying it shouldn't be pointing towards injury and distress, but the court reads the complaint's damages, reads the settlement agreement, releases language, and looks for proof that the dollars were paid on account of personal physical injury or sickness. Without that link, the court treats the payment as a termination settlement, taxable. And here's a mildly satirical part that the opinion itself practically invites. The signature paid language, employee acknowledges, she read and understand, sits like a trapdoor. The court doesn't call it a trapdoor, but it uses the clarity of the agreement against the taxpayer's claimed confusion. If you're watching this and thinking, so the legal system expects regular people to understand dense settlement language, yes, at least to the extent that the signed writing can control the tax characterization when the court finds it clear. The ending is brisk. The court says it considered all arguments and anything not addressed is moot, irrelevant, or without merit. Then it concludes the bench opinion and states that the appropriate decision will be entered. So if you are negotiating or signing a settlement and you care about how it will be taxed, this case is a reminder, based on exactly what the court emphasized, that the complaint, the damages you actually claimed, and the settlement agreement language can be the difference between excludable and taxable. Or, put more bluntly, if the paperwork tells the story of wages and termination, the IRS is going to tax it like wages and termination, and the tax court may agree. My name is Alex Dvorkin. I'm a certified public accountant in the state of California, and if you like this video, please give us a thumbs up and subscribe to this channel. And I'll see you in the next tax court case review.